Good morning, everybody. This is Michael coming to you from Game Edge on Friday, June 20th, with our pre-market prep session. As always, here at Game Edge, we start with our three pillars: sentiment, structure, and trend. We're currently looking at our market trend model, which is based on the tick index. This bolded white line here is our instantaneous intraday cumulative tick. This continues to the downside below these shorter term moving averages, indicating that there's more selling versus buying occurring in the market. As you can see, it started to turn back here on the 15th, 13th, and then we continued on the 16th, and then we've continued down below those moving averages. We've tried to do some short-term recoveries, but those continue to be met with continued selling and overall price depreciation of this green within the overall SPX. Breadth indicator, new highs versus new lows. We did see new highs on Wednesday, outpaced new lows, but just slightly, not by a significant margin. Institutional cumulative tick, plus 1,000, minus 1,000 filtered larger block orders was basically flat for the day, and then saw some weakness into the afternoon. So not a significant change in that. And then the cumulative tick was just barely living above zero, and then finished the day almost flat. So really no indication directionally wise there, but then our instantaneous CT again is above those shorter term gray moving averages, indicating we're going to start the day with a little bit more bearish stance, at least via the market trend model, even though we're seeing some gap up this morning in price appreciation. Our longer look back period is our ribbon, red above cyan, is still overall bullish for a longer term period, 30 days, somewhere around in there. But we are seeing this bolded CT or cumulative tick start cutting into the colored ribbon. So that is an indication of possibly some weakness coming into the market, as we've seen via price depreciation the past few days to weeks. So we'll keep an eye on this. Historically, what we want to see is the pullback to the colored ribbon area via the bolded white CT, which is our cumulative tick, and then we want to see recovery back to the upside if the bulls or buyers are going to maintain control of the overall market. If we're going to see a further downward turn or overall market weakness, more than likely we'll see this bolded CT start cutting through all of these colored ribbons and emerging down below the cyan to the downside. Moving on to the SPXA, this is our cruise ship. Again, expiries that turn over less rapidly than the SPXP and 0DT. So these are institutionals or larger market participants. You'll know the July expiry is practically zero GEX, so that's balanced from a call to put standpoint. We are call dominated, but indicating that most institutions are basically not positioning directionally at the moment, at least extreme directionally at the moment. So basically balanced. We see this transitions extremely wide, so that's uncertainty in the overall market. And then just a spattering of negative and positive deltas via the red and green. So again, this is just an overall messy structure, but really not any indication directionality wise, even though we are call dominated. So we'll give an edge to the bulls on the SPXA via the July expiry. Aggregate, the next three expiries, again, call dominated above and below spot price, but you'll notice that we're extremely balanced with only 4,000 net GEX. So as I said in the previous slide, as well as the 24 million net gap at previous slide, really not directionality positioned via larger market participants or institutions. So it seems like we're just a wait and see approach. And then also remember that we're heading into the summer months where trading and volume can drop significantly. So it may not be until the obviously August or September expiry where we start to see some significant directional positioning come out of the SPXA. So we'll continue to monitor this, but as of now, it's fairly balanced. Institutions not really putting risk capital to either direction via the SPXA. SPXP, these contracts turn over much more rapidly, as you'll notice by the 0DT as well as the weekly expiries. All expiries turned on here via the purple tiles. We are put dominated. We do note the JPM June short calls down here at 59.05. You'll see the transition areas are a little bit wider, but not extreme. So 60-40 to the upside. That will be a confluence point here in just a minute as we'll discuss 0DTE. PGEX up here at 6,100. You'll note that COI is at 6,000. This is the highest call open interest. So again, important round psychological level as well as a level from a options positioning perspective. And then we have COTMP down here at 59.70, which historically is an area where you see some profit taking via the puts that are out of the money become in the money, and then this can become a supportive area. So we'll continue to watch this these areas as we head into this expiry today. But the quick takeaway is put dominated, so a little bit weaker structure, transitions very well defined. To the upside, 60-40, 60-50 may be a cap on price, and then we have COI at 6,000. So we'll continue to watch spot price action within this overall transitions. And then to the downside, if we do get below 59.70, we'd look for 59.50 to be a supportive type area, and then obviously 5900 to the downside. The GEX ratio for the SPXP, we've been talking about this really for the past few days to weeks as it was continuing to weaken. Indicating that short-dated call gamma was leaving the overall complex and put gamma was being exposed. We are below that 1, which is that balance point, theoretical balance point between calls and puts. If we're above 1, we lean a little bit more bullish. If we're below 1, we lean a little bit more bearish, but we're only at 0.87, so not historically bearish at the moment. But we'll give an edge to the bears on this SPXP GEX ratio, indicating there is a little bit more short-dated put gamma within the overall complex, which will show up on our web app here in just a few minutes also. Delta balance SPXP, again, just separating the overall above and below spot price for market participants, indicating how they're positioned. So you'll note that we did see continued weakness via the delta balance. So again, that's short-dated call gamma being less than short-dated put gamma in both planes. So we saw that drop, as well as the delta balance down towards -1. And now we're seeing some recovery heading into today. So we could lean this a little bit more bullish as the delta balance has crossed back above 0. We see that right-hand plane, which is the green dotted line. That's your out-of-the-money call speculation, which is not significantly rising. So again, significant price appreciation will most likely be dampened. But we did see that short-dated put gamma recover pretty quickly, as most likely market participants took profit on the move down in the overall SPX on short-dated put positions. And then we saw that recovery exposing the in-the-money calls below spot price. So any pullback should be supportive today unless we see a significant amount of out-of-the-money put speculation via our intraday volume commands, which would be vol M and vol D and vol U. So we'll watch that intraday to get an idea of how market participants are positioning for intraday moves. But again, short-term recovery, so we'll give an edge to the bulls here. And as you can see via the tools, we're kind of conflicted via put gamma, GEX ratio, and call gamma, as well as the MTM. So we'll head to the SPX P0DT, our web app, to get an idea of where market participants are positioned heading into today. Via the SPX option structure. Legend down in the right side, you'll notice that GEX and DEX are a confluence today. This makes it very easy for us as traders to understand that if we're above the transition, we lean a little bit more bullish. If we're below transition, we lean a little bit more bearish. And then we have our drunken sailor range, which is outlined with the orange. Again, low exposure areas that'll be driven by intraday volume, as well as intraday market participants positioning. To the upside, we see 60-50. We believe that's probably going to keep a cap on price, and unless we see a significant news event, as we see a COI up there in PGEX at 60-50. Again, highest call open interest. Most likely, if we get up to that level, we'd see some sort of monetization event, as well as the top of the drunken sailor range. We have in the money puts above us. So again, price appreciation to the upside most likely will be dampened. To the downside, if we're below transition, we see COTMP there at 59.70, the bottom in drunken sailor range, large confluence there. And we actually have some in-the-money calls come in that will most likely be supportive, 59.45 and 59.50 would be that lower level that we'd look for an opportunity for a bounce. First level would be 59.70. We'd look for a bounce there. And then 59.45. If we come up and test the overall transition from below and start to see some stalling or rejection, that would be a short, most likely for a short-term short for a move to the downside. And then if we're above transition and above that 6,000 level, we'd look for an opportunity to move to the upside at 60.35 and 60.40. And if we see a failure around there, some pausing, stalling, and failure, depending on what the market trend model is indicating, as well as our vol M command, this could be an area possibly for a short-term quick short back to the downside to the top of transition. So hopefully that's outlaid very well. Above transition, the areas we look for price appreciation, as well as stalling, and then opportunity to short those levels. And then if we're below transition, the areas that we look for bounces. And then if we see some testing of the underside of transition and failure, then we'd look for an opportunity to short back down towards these key levels. That's it for me today. Thanks everybody for joining us on a Friday. Everybody have a great weekend. I'll hang around for a couple minutes if anybody has any questions about the overall positioning and structure for today. Again, heading into today, put dominated. levels are outlined very well, drunken sailor range as well as the transition areas, and whether we're bullish or bearish above or below those. The MTM heading in today is slightly bearish, so we'll continue to watch that to see if market participants are selling more than buying. Overall, we're just barely testing the 6,000 level here pre-market, as indicated here by the pre-market price action. So we'll continue to watch that. 6,000 definitely is the psychological level, most likely that we'd like to be above. And then we see P-Trans up there at 640. Yes, yes. Correct, Jai. Yeah, that's basically how I'd be looking at the overall structure heading into today. Obviously, intraday volume will be driving price action as we're within this overall drunken sailor range. So we'll continue to watch that intraday. But yes, the quick takeaway is the TLDR. That's why we make it very simple here at GameEdge, and that's why we continue to do the same systematic approach. If you're above transition and above 6,000 transition, mainly we would look for a little bit more bullish, even though we're put dominated, most likely some price appreciation. Overhead price appreciation may be difficult though because of all these in the money puts above us. But again, above transition, we lean a little bit more bullish, most likely testing up towards these levels here, 60.35, 60.40. And then below transition, we look for 59.70, and then below that, most likely 59.50 or 59.45, correct? Yeah, somewhere around in there. And once we get below the drunken sailor range, we increase the overall bearishness down towards this 59.45 level. So yeah. Again, also driven by intraday metrics. So if if price is dropping, but we're not seeing a significant amount of out of the money call speculation volume wise, then most likely price depreciation will stall at those key gamma delta levels below us. Now, if we see on our vol-m command that the call and put centroids are linear down, then market participants are speculating to the downside with out of the money positions pretty significantly. So then that may lead us to be a little bit more bearish, and the ease of pushing through those levels might be slightly easier. So the other takeaway is to understand where your gamma and where your gamma kicks in and where it will be the highest sensitivity point if we move through those levels. Obviously, if we move through 60.40 and 60.50, that'd be a high gamma sensitivity point, and we most likely see a pretty quick sweep move to the upside, probably towards 60, 65, or 70. And this would most likely be a news-driven event. So yeah. Zach said, would you say that a put dominated tag would lead more bearish below the drunken sailor range, or not so because COTM and PX is met? Yeah, so let's separate that here. So put dominated, obviously, your higher volatility, right? And then what that comes with the overall market maker positioning or a dealer hedging that has to occur in a put dominated environment. We put out a great overall education about market maker and retail yesterday, so make sure you check our X account and read up on that. So how I do it is I do it obviously systematically, or do here at GameEdge. We look at the overall structure. So we're put dominated. We look at the overall sentiment. What is the overall sentiment coming into the day via market trend model, as well as positioning. And then we look at where price is to the transition areas, right? So those three things will be leaning us a little bit more bearish if we open below transition, or if we open above transition. And then we could easily flip to call dominated today. Our net GEX is negative 11,000, so it is a little bit higher. But if we're above transition and we start seeing those in the money puts above us start to close, and some out of the money call speculation come in, we could flip to call dominated. That's why we let the morning opening range clear. All of the market on open orders will, clear out the books, and then we'll get an understanding of where market participants might be repositioning. But yeah, below drunken sailor range, we'd lean a little bit more bearish. If the COTMP was down further, down at 59.45 or 59.50, then I'd say that would be a very logical short down towards that level for a quick move. So yeah, and pullbacks, as you see here, we do have some green net delta below spot price and below transition. So as long as these call holders maintain these overall positions you see over here, call and put OI, so we like to understand where those highest sensitivity areas are. So these are areas where we could see stalling and supportive type action, and then move back to the upside. So that's why we watch those, and that's why your 0DT trades should be much shorter, right, in duration. You're not looking for a significant move via the 0DT trade. A 59.70 to 59.50 move is a large move for a 0DT trade, so that should satisfy your overall trading plan and trading conditions. You're not looking to hold 0DT contracts unless you get a really large move and you can trail spot price really quickly, unless you're getting it from 59.45 to transition. So personally for me, I mean, I'm always, once the trade starts moving in my direction, I'm always starting to take profit off the table. So for instance, let's just say we had a pullback to 59.45. It looked like it was going to be supportive. It was met with some overall closing of puts, opening of calls, and I took a long position. I'm already doing, once this starts moving back up towards that 59.70 level, I'm already starting to take profit, maybe even quicker than that, depending on how volatile the environment is. And then I'm going to hold a portion of that position for a move back over towards transition. I'd probably take some more off at transition, and then if we see some stalling or rejection into transition, then I'd definitely be looking to get out of that trade, obviously on 0DT contracts, if you're just doing directionally wise. Preferably the other way would be to do spreads, verticals, diagonals that allow you to manage your risk right up front, take advantage of sideways price action, as well as slight directional moves, and that just gives you an overall better risk reward for the trade instead of just doing directionals. So anyway, hope that helps. All right, thanks everybody for joining us. Make sure you check it out. Check out our X content, as well as sign up for our newsletter on the weekend. Again, we go over crucial points in the market that we use for overall positioning and overall understanding of the SPX options complex, as well as how to do our trading plans. So thanks everybody. Have a great day.